Hello and welcome to today's Delta Credit Tip. So you pull your credit from Equifax, you get one score, Experian a second score, TransUnion a third score, Bank of America a fourth score, and Fifth Third a fifth score, all on the same day. What the hell, right? What is this score all about? How do they come up with this number? How does it really relate to me? And why is it so confusing? Well, stay tuned. We'll add a little clarity here on today's Delta Credit Tip. Hello and welcome back to today's Delta Credit Tip. So I pull my credit from all these different resources and every single resource seems to give me a different number. I don't understand why it isn't equal across the bureaus. I don't understand why Bank of America has a different number than me than say Regions Bank. It doesn't make a lot of sense, right? But we're going to add a little clarity today about the credit score, what makes it up, really what is it all about, and how it affects you, okay? But before we get into all that, we serve a lot of information here on the YouTube channel for Delta Credit Restoration. Subscribe below, hit the bell, because every Thursday we're going to come out with more information to help you in your credit restoration process, and you want to get it right out of the gate, right? So again, subscribe, hit the button, but most importantly, people, you've got to share this information with others. This is how we stay informed. This is how we collectively make a difference in our lives financially, but more importantly, it's how we make a choice to make that change here at Delta. So let's talk about that score, okay? So the first thing I want you to remember about the score is that the score is not for you. Your score isn't for you. It is for the lender, okay? Not only that, FICO, the company that makes your credit score, makes 62 versions of it. There is more than one version of your credit score. And a lot of times, these credit scores are related to a specific industry: insurance, credit cards, rental history, insurance, car accidents, criminal history. All of these things come up with different types of credit scores for you. But we want to go a little bit deeper than that. The one thing you got to remember when trying to understand the chaos that is a credit score is that the company that makes your credit score, FICO, and the companies that use your credit scores, Equifax, TransUnion, Experian, lenders, debt collectors, all these other companies, every last one of these companies are for-profit companies, and they are not government, okay? And they all work together, okay? Think about it this way. When you call Equifax or Experian or TransUnion or LexisNexis or any of these bureaus that are out there, tenant data, right? Check systems. If you ask for a copy of their credit report, they got to give it to you for free. If you do a dispute, they've got to investigate it for free. And they got to go through all this mail and all this electronic stuff, hire all these people to support you. You are not the customer of the bureaus. You are the natural resource. They buy and sell your information to their true client, the debt collectors and the lenders. See, you're just the natural resource. They are the client. So your credit score is a litmus test that lenders use to weigh your behavior against their risk tolerance. Okay? Now, the thing about the bureaus, again, they're all for profit and they're all independently owned. Equifax is not related to TransUnion or Experian and neither in between. Okay? So as a creditor, I may not want to pay all three bureaus. So as such, if I, Bank of America, let's say, report you only to Experian, then only Experian will have either that positive or negative effect that our relationship has had on your credit report. Right? So that's one reason why between bureaus, your score can be different. Secondly, most lenders now have their own filtration system once they actually pull your information directly from the bureau. Once it goes through that filter, right, the resulting score can be different than what the original score they got from the bureaus. Okay? So that's why if your score with Bank of America is, say, a 700, and your score with the local community bank, say, Mid-Florida, right, Federal Credit Union, right, they may like your 650 more than Bank of America likes your 700. Okay? So that just adds a lot more ambiguity as to what's really a good credit score and what isn't. Because see, the thing is when you go on, say, one of these third-party bureau websites, right, and they say, well, I've got a 680, and they say, yeah, their credit score is fair. Well, why would they do that? A 680 credit score is good enough to get anything really on the planet. Right? You can get a car, you can get a house, you can get a credit card, you can get insurance, you can get a job with a 680 credit. So why is it just fair? Well, remember, the bureaus work with, including FICO, work with the lenders. They all work together. They pay them for your credit report and your credit score and to add to the data that makes that number. So if they make you believe that a 680 is just fair, and you believe it, then you'll also justify in your mind the interest rate that they're trying to shove down your throat. I'm just saying. But it doesn't stop there. Okay? Remember, your credit score kind of works like a GPA, right? You turn in all your homework assignments, right? Everything's great. But then you forget to turn in that one homework assignment. I dropped to a C. But if I turn in my next homework assignment, I don't just jump back up to an A. I got to get 25 more A's just to get to a B, and 25 more A's to get to that A minus. And when it comes to a credit score, the whole time you're hovering from a C and getting back to that A, guess what the paying customers of the bureaus get to do? Charge you more interest. Funny how that works. Okay? You've got to also remember that your credit score is a corporate product. It is not a consumer product. It's not meant for you, and it's made by for-profit companies looking to make money off of lending you money. Okay? So they all kind of work in tandem. So since we have to still work with these scores, it's a good idea to understand how the score is calculated. Okay? So the first part of your score, first off, there's 5 major components to your score. And each compartment of your score is independent of the other. And every account within each category is independent of all the other accounts within that subgroup. So the first subgroup of the matrix of your credit score is the payment history. How consistently are you paying on time? Okay? So for instance, if you have a bunch of student loans that are in deferment, but they're in a positive status, it's not really helping your scores in that category because while the accounts exist, there's no payment history hitting that category every month. Right? Just like if you have a bunch of credit cards just sitting there stale, again, they exist, but they're not hitting that specific category. Okay? Now, if you've got debt collection accounts, that's going to weigh down your potential point value in that payment history category, which just so happens to be the largest part of your credit score. Okay? So we got to make sure that you don't have a bunch of collections on there and you're actually making payments on your credit to have that payment history give you point value. Okay? The second matrix that they look at to create your credit score is what they call the debt to credit ratio. What are the balances on my accounts versus the limits on my accounts? And this is where we have what we call the 30-30 rule. Once you go above 30% utilization on your credit scores, you're going to lose as much as 30% of your score. Now, the same is true also about not having any revolving credit. Okay, if you have no revolving credit, then that matrix simply isn't being calculated again at all. right? So you're just simply missing out on those points. Okay? So for us, a lot of times, a great place to start in building your credit is focusing on payment history and the amounts. So if you have no credit cards, by adding one on there, you can add to both payment history and the debt to credit ratio, which helps out quite a bit. The third matrix that they look at on your credit score is the average age of the account. So this has a lot of implications to it. The older the accounts, the positive accounts are, the more it can affect your score. Okay? So we don't want to be closing out a bunch of stuff if we're trying to increase our score. We had a guy one time pay off a car and it completely tanked his score. Why? Because the credit bureaus don't care about what you used to manage as far as your debt load. They're only worried about what you're currently managing. So when an account closes, it no longer contributes to the score and can actually lower the score once it closes. Okay? And a lot of times it has to do with the average age. So as your accounts mature, you need to make sure that you've got accounts that you want to keep. They're absent of long-term fees and issues with cards, so that you've got one that you're willing to keep for a long time. Okay? The fourth matrix of your credit score has to do with new credit. Applying for credit, how many times you've applied for credit. And what we have found is that if you apply for credit and you get it, your score can go up about 10%. If you apply for credit and you don't get it, well, then your score goes about 10% down. Okay? And we're going to get back to that because that's an important thing. Because when you go to a bank, right, a lender can't tell you whether or not you can get approved for a loan. But they should be able to tell you if you're going to get declined if you're coming there prepared. Okay? By the time we're done with this video, and if you go back and watch some of the other videos that we have at the Delta Credit Restoration YouTube channel, we basically tell you how to assess your own credit. So you can have a competent conversation with the lender, and before you actually apply for that credit card or that business loan or that mortgage, you can simply ask, hey, here's my matrix, here's my credit score, my debt to income, my debt to credit, my work history, my income, all this stuff. What are your guidelines? Am I going to get declined? Right? So knowing that information can help that new credit category keep from hurting you. Okay? The last category, which is again another 10%, is having variety in your credit. They like to see that you can juggle different kinds of debt. I don't really care about this. Because think this through for a second. If you have a variety of types of debts, then that means that it's going to cost you interest, because the only type of loan that doesn't cost you interest is revolving credit, right? If you use your credit card and pay it off at the end of the month, there's no fees, there's no interest, right? The effective rate is 0. So if they want me to have a variety of debt, then that means that the bureaus and FICO are encouraging me to carry debt to pay their customer who pays them. They work together. But here's the thing. 80% of your score can be accomplished by revolving credit. Payment history, debt to credit ratio, average age. I don't have to carry debt to have good credit. So I know the score can be confusing depending on where you pull it from and why you're using the score. But I hope this information can kind of add some clarity as to the general makeup of the score and how it relates to you as a consumer from them, a corporation. If you've got more questions, feel free, ask us below. We'll get back with you with answers to maybe add some more clarity. But in the meantime, make a choice, make a change. Delta.